Hey everyone, welcome to the channel. Before we dive in, let me quickly introduce myself. I go by Pips Hunter. I've been trading and educating in the Forex world for the past 5 years, and today, I'm excited to bring you my very first long-form video. If you're looking to simplify your trading and seriously boost your win rate, you're in the right place. On this channel, we'll break down Forex trading into easy-to-understand steps that anyone can follow. Before we get started, I want to give a huge shout out to ICE ET Trader and Arjo. Their insights have been instrumental in my journey, and I'm here to share that knowledge with you in a way that's clear and actionable. In this first video, we'll be focusing on PD arrays, the foundation of everything I'll be teaching in the upcoming videos. Stick with me, and I promise to keep it short, clear, and packed with value. All right, let's dive into PD arrays. So, what exactly are PD arrays? It stands for Premium and Discount Arrays. Think of them as zones on your chart that can act like support and resistance levels, places where price can either bounce off or break through. A premium array is a bearish zone, meaning the price is likely to move lower from it. On the flip side, a discount array is a bullish zone, meaning the price is likely to push higher from it. Now here's a quick rundown of the PD arrays we'll be covering in this video. Fair value gaps, fair value area, order blocks, and swing points. I'll show you what each one looks like and how to spot them on your chart. And don't worry, in the upcoming videos, we'll go deeper into each PD array, exploring how to identify the higher probability ones, and much more. Let's talk about fair value gaps, or FVGs for short. An FVG is essentially a 3-candle pattern that leaves a gap in the price action. Here's how a bullish fair value gap forms. The first candle does its thing. Nothing special yet. The second candle closes with its body above the high of the first candle. The third candle doesn't trade back into the high of that first candle, leaving a gap. This is our fair value gap. So once the third candle closes, you'll either have a fair value gap or not, depending on whether it trades back into the first candle's high. For a bearish fair value gap, it's just the opposite. Now, it's important to understand that fair value gaps are crucial. They're like the king of PD arrays. If you don't get FVGs, the rest won't make much sense. And because there are different types of FVGs, I'll be dedicating an entire video to dive deep into them. But for now, all you need to know is what they look like and how to spot them. Let's jump into the charts and see this in action. If we mark all the fair value gaps on this chart, it would look like this. Bearish ones here, bullish ones here. But not all FVGs are relevant. The ones that have already been traded into are considered mitigated and can be removed. Once we delete those, we're left with the active fair value gaps. The bearish ones will serve as our premium arrays, while the bullish ones will act as discount arrays. Want to learn more? I'll be sharing some challenging quizzes on how to spot these fair value gaps in my free Telegram community, which I'll share with you at the end of this video. Let's dive into swing points. Swing points refer to both swing highs and swing lows on your chart. So, what exactly are they? A swing high is a 3-candle pattern where the middle candle sticks out at the top, with the candles on either side lower than it. Simple, right? Now just flip this for a swing low. The middle candle sticks out at the bottom, and the candles on either side are higher than it. These points become swing highs and lows. But there's a catch. They're only confirmed once the third candle closes. And guess what? These swing points can also be identified through the previous candle high and previous candle low. But what are those? It's pretty straightforward. The previous candle high is the highest point of the candle just before the one currently forming, and the previous candle low is the lowest point. Think of these as swing points on lower time frames. Now let's see this in action. Let's mark all the swing points. Done. These are the swing highs and these are the swing lows. Notice something? There's a swing high currently forming, and once this candle closes below, it will confirm this as the swing high. Let's take it a step further. By marking the previous candle high and low, you've automatically marked the swing points on lower time frames. Let's zoom in and see. Boom. There they are. The swing high and swing low right there. One last thing. These swing points often act as price targets, but we'll dive deeper into that in upcoming videos. Stay tuned. Next up is the fair value area, an essential PD array. Now, to really grasp this concept, you'll need a solid understanding of market structure and order flow. Don't worry, we'll dive into that in the next video, but for now, let's keep it simple. The market only does two things. It offers fair value or it seeks liquidity. So, what exactly is fair value? Fair value is when the market gives both buyers and sellers a fair chance to participate, creating a fair value area. Think of liquidity as the swing points in the market. A fair value area is defined by a three-swing movement. Here's the breakdown. The first swing is a bullish move, giving buyers a chance to jump in. The second swing is bearish, attracting sellers. The third swing is bullish again, creating a low and breaking the previous high. The fair value area is the space between that high and low. In this example, it acts as a discount array. For a premium array, it's the opposite. But there's more to fair value areas than just that. To fully understand it, you'll need to get a handle on market structure and order flow, which, as I mentioned, we'll cover in detail in the next video. Stay tuned. All right, let's dive into the final PD array for this video, the order block. Just like the name suggests, order blocks are clusters of orders placed by big players in the market. A bullish order block is the last down close candle, or a series of them, before the market makes a strong move up. On the flip side, a bearish order block is the last up close candle, or series, before the market drops. So, how do you spot these powerful zones? It's pretty straightforward. First, identify where liquidity has been swept. Next, look for a break in market structure. Finally, find the last up close or down close candles just before that liquidity sweep. By following these steps, you'll be able to pinpoint those key areas where the big players are likely to step in. All right, traders, let's recap what we've covered in this video. We dove deep into some essential PD arrays, fair value gaps, swing points, fair value areas, and order blocks. Each of these concepts is crucial for refining your trading strategy and understanding market behavior. But we're just scratching the surface here. I've created a Telegram channel called Pips Patrol, where we'll dive even deeper into these topics and more. I'll be sharing quizzes, ebooks, and a ton of examples to solidify your understanding. Plus, you'll get to join a community of like-minded traders using the same strategy. You can ask me anything about trading, and I'll be there to help you out. The link to join is in the description below. I can't wait to see you in there and help you take your trading to the next level.